If you're within 10 years of retirement and your money is sitting in an S&P 500 index fund, you probably think you chose the safe option. Diversified, simple, boring. But today, that safe fund may be far more concentrated than you think. And most of that concentration is tied to the AI boom. And that AI concentration matters most if you're close to retirement. Because near retirement, the real danger isn't just a crash. It's a crash at the wrong time. I'll show you how one bad decade can leave damage you may never fully recover from. Start with what's actually in your fund, not what you were told, what's really in there. You bought an index fund because someone smart gave you good advice. Don't pick stocks, buy the whole market, stay diversified. And for a long time, that's exactly what you got. But the S&P 500 isn't 500 equal companies. It's weighted by size. The bigger the company, the bigger its slice. And right now, the 10 biggest companies make up about 40% of the entire index. Let me put that in dollars. For every $1,000 you put into an S&P 500 fund, about $400 lands in just 10 companies. And roughly $70 of that goes into a single stock, NVIDIA. $70 of every 1,000. One chip maker. It's the biggest single position in your diversified fund. And most people have no idea it's there. Those 7 names, the ones everyone calls the Magnificent Seven, are now about a third of the whole index. So you thought you bought the market. What you actually bought is a concentrated bet on a handful of American tech companies, almost all of them riding the same wave, artificial intelligence. And you didn't choose any of it. You never picked NVIDIA. The math picked it for you. I care about this more than the average finance channel, by the way, because I learned the hard way that timing can wreck even a good plan. I'll come back to that. Quick thing. I'm Jake. If this is useful, subscribe. This channel is for people near retirement who don't need hype. They need clear math. That's it. Let's keep going. So how does one chip maker end up being $70 of every 1,000? This is the part almost nobody explains. An index fund weights companies by market value. So the more a company is worth, the bigger its slice. And the more of your next contribution flows straight into it, automatically. Picture how that plays out. NVIDIA climbs. Its slice of the index grows, which means the next dollar you invest buys more NVIDIA, which helps push it up again, which makes the slice bigger again. More money in, more concentration. The thing feeds itself. That's what quietly turned your diversified fund into a concentrated one. You didn't change anything. You kept doing the boring, responsible thing. Buy every month, don't touch it. The structure changed underneath you. And honestly, on the way up, this is a beautiful machine. Anyone holding the index got pulled higher without lifting a finger. I think cap weighting is genuinely brilliant in a bull market. The problem is that the same machine doesn't have a brake. So here's a fair question. If it works this well going up, what happens when it runs the other way? Hold that thought. Now you might be thinking these are the best companies on earth. They're not going anywhere. Maybe. But every generation believed that about its giants. And you might disagree with me on what comes next. That's fair. So let me just give you the history and let you sit with it. There's a well-known study by Professor Hendrik Bessembinder. He looked at nearly 26,000 U.S. stocks over 90 years. His finding? A little over 4% of them created all the net wealth the entire market ever produced. The other 96% put together barely beat a treasury bill. 4%. And the catch is that those 4% keep changing. In March 2000, Cisco was the most valuable company in the world, over $500 billion. Then it fell almost 90%, and it took until December 2025, 25 years, for the stock to finally hit a new high. 25 years just to get back to even. General Electric sat in the Dow for 111 years, the last original member, gone in 2018. And then there's Japan. In 1989, the Nikkei was the envy of the world. Then it dropped about 80% and didn't reclaim that high until February 2024. 34 years. A Japanese investor who retired in 1989 on those unstoppable companies spent their entire retirement just waiting to break even. I'll give you the honest counterpoint because it's real. Today's giants actually make money. Apple, Nvidia, Microsoft throw off enormous cash. The top 10 earn roughly a third of the index's profits. That's genuinely different from the dot-com fantasy. I'm not predicting they'll collapse. I'm saying too big to fall has been wrong every single time someone believed it. But the concentration isn't even the real danger. The real danger isn't what you own. It's when it hits you. And that changes everything. This took me far too long to understand, so let me save you the trouble. While you're still saving, a crash is actually good news. The market drops, your monthly contribution buys more shares on sale. Early bad years? You want them. Retirement flips it completely. Now you're not buying, you're selling. Every year you sell a few shares to live on, and if the market is down when you sell, you have to sell more shares to cover the same bills. Those shares are gone. They're not there to bounce back when the market recovers. So it isn't the crash that ruins you. It's the crash while you're withdrawing. The researcher Wade Pfau put a number on this. Roughly 77% of how your whole retirement turns out is decided in the first 10 years. That early stretch carries almost the entire outcome. Let me put real numbers on it. You retire at 65 with $500,000. You pull 4% a year, about $20,000, and you nudge it up a little each year for inflation. The market averages a healthy 7%, and somewhere in there, you hit one crash, down 40%. One crash. The only thing we change is when it lands. First version. The crash comes about 10 years in, around age 74. It stings, but your money had a decade to grow first, and years to recover after. Here, it lasts until about age 94. Second version. Same person, same 500 grand, same 40% crash. Except it hits 2 years in, around age 66, right at the start. You're selling shares into the drop to pay your bills, locking in the loss. Here, you run out of money at 87. Same crash, same portfolio. The only thing that moved was the timing, which you never controlled. And it cost you 7 years. 7 years where, in one life, you're fine, and in the other, you're 87 with nothing left. That sequence of returns risk, and almost nobody warns you about it while there's still time to plan around it. I told you the timing is something you don't choose. That's true. You can't predict the crash, but you can spot when you're most vulnerable to one. And right now, a huge number of people are walking into their most vulnerable years all at the same time. Starting in 2024, more than 4.1 million Americans a year are turning 65, over 11,000 people a day. They call it Peak 65, the biggest retirement wave in the country's history. And more than half of them have serious $250,000 or less saved. Sit with what that does. A historic wave of people stops buying the market and starts selling it to live. And remember the snowball? It runs in reverse, too. The same mechanic that poured money into those megacaps can pull it back out, right as this whole generation enters its most fragile years. And this isn't just a someday problem. In June 2026, we got a reminder of how fast the AI trade can shake. Several big tech and semiconductor names sold off hard, and the chip index had one of its worst weeks in over a year. A few high-profile investors, Michael Burry, the one from The Big Short among them, have publicly bet against parts of the AI trade. Doesn't mean they're right. They've often been early. But it tells you serious people are taking this seriously. The only question is whether you are too. So far, we've got two layers, the concentration and the timing. There's a third, and it's you. Every year, Morningstar measures the gap between what funds return and what investors actually earn. Over the last decade, funds returned about 8.2% a year. The average investor in those same funds earned about 7.0%. That 1.2-point gap, roughly 15% of your total return, just disappeared. Not to fees, to timing. People buy after things go up and sell after they go down. Under stress, the human brain is wired to do the exact wrong thing. Stack them up. The structure concentrates your money. The timing of your retirement decides how much a crash actually costs you. And instinct makes you sell at the bottom. 3 layers, and they don't cancel out. They add up. Let me be straight with you, because I've lived a version of this. A while back, I lost almost everything. A business that went under. And then, right in the middle of clawing my way out, a cancer diagnosis. And the part that stays with you isn't only the loss. It's realizing how much of it came down to timing I never controlled. I did a lot of things right. I just did some of them at the wrong moment. Here's what I took from it. You will never control the market, and you'll never know when the next crash shows up. But you are not helpless, because some things are completely in your hands. You can know what you actually own. Go look at your fund's top 10 holdings tonight. It takes 2 minutes. You can know where you sit on the timeline. The closer you are to retirement, the more that first decade matters. And a lot of people in that window think hard about keeping a cushion, money they won't have to sell in a downturn in those early years, so they're never forced to sell at the bottom. I'm not telling you to sell everything and run. That's its own mistake, and nobody can time this anyway. This isn't financial advice, it's a lens. The people who get hurt are the ones who never looked. You just looked. So, to bring it home, your index fund is more concentrated than it has ever been, mostly on AI. How much a crash hurts depends almost entirely on when it lands. And the biggest retirement wave in history is starting to sell, right as today's retirees enter their most fragile years. At the start, I said you probably think you chose the safe option. The truth, you did choose the safe thing, for the last decade. The safe thing for this one is simply knowing what you hold and knowing when you're exposed. That's not panic, that's control. If this gave you one thing to check tonight, do me a favor. Like it, subscribe, and tap the bell so the next one finds you. And watch this one next. It's where I break down how people build that cushion without trying to time the market. See you there. This video is for education, not financial advice. Past performance doesn't predict future results.